delay. We'll have Dan, please, you can start your presentation anytime you like. The floor is yours.
Thank you, Donald. It's good to be with you once again. I'm Daniel Moss. I'm a columnist at Bloomberg Opinion in Singapore. The views I'm going to express here are my own. They do not necessarily reflect those of the editorial board of Bloomberg LP nor its owners. As a columnist, it's my job to express an opinion, and that's what I shall endeavor to do. So there is no question that Asia, in aggregate, is experiencing a very strong economic recovery. You know, when we gathered 12 months ago, we looked forward to both the recovery and the reopening, and we tended to view those things as pretty synonymous. Turns out they're not necessarily. We do have a vigorous recovery underway. We have a very uneven reopening, and you know, even the term reopening itself, you know, Donald, I think there could be a whole hour-long discussion on the nuances of that and what it means to different people in different places. Let's zoom out a little bit. So for all the talk about the post-pandemic new normal, the global economy is still intimately tied to developments in finance, commerce, policy in the United States and China. The economic duopoly, which has really guided the global economy for the past decade, is alive and well, though each of them has increasingly divergent views on where to go from here and where to go with each other. China was first in, first out. It was the only major economy in the world last year to show any kind of GDP growth. The US has subsequently come on strong, particularly with fiscal stimulus and with monetary stimulus. When you look at the upgrades to global growth forecasts, including those in Asia, the big swing factor coming out of last year into the start of this year was the amount of fiscal stimulus coming from the United States, buttressed by the monetary stimulus, which began in March last year. China has not done as much stimulus. It also recovered sooner, and its economy is so much bigger than was the case coming out of the global financial crisis a decade ago. That said, you know, you can make the argument that there, in some ways, is no Asia. This is not a region that is recovering and reopening in any kind of lockstep. To the extent you can draw a line, you can probably draw a line between Northeast Asia and Southeast Asia, with Northeast Asia coming on strong, benefiting in large degree from its exposure to technology exports. You can say these have been some of the real work from home winners. I'm talking not just about China, I'm talking about South Korea, I'm talking about Taiwan. I'm also talking about Hong Kong, not thought of as a tech base, but it is certainly an exporter. After a couple of pretty lean years, even before COVID hit, Hong Kong's economy was not in great shape. The IMF is forecasting growth of approaching 5%. Our own economists at Bloomberg Economics are talking about something much closer to 7%. Now, in Southeast Asia, with the exception of where I'm sitting now in Singapore, it's still a pretty dire situation. Indonesia reported a record number of COVID deaths and a record number of COVID infections today, more than 20,000. Malaysia remains in a state of emergency. The Philippines is doing it tough. Those three economies are still deeply mired in recession. Singapore is going to have one of its strongest years this year in terms of GDP after the worst year in its history as a republic last year. Let's talk about the risks to this outlook. You know, Donald, I'd say they broadly fall into two buckets. One is very tangible the other more difficult to quantify, but we'll have a crack at that anyway. First, the tangible one. Probably the biggest risk to global markets, including those in Asia, is the danger of disruption related to the withdrawal of this enormous stimulus that was pumped into the global economy last year. We may have had a healthcare crisis last year. We did not have a financial crisis, thanks to very, very speedy action from the world's biggest central banks, principally the Fed, but not just the Fed. And that reflected the dollar's role as the global reserve currency par excellence, without peer. You can talk about whether that's a good thing or not, that it matters or that it happens. It was consequential. So at some point, this monetary stimulus is likely to be dismantled. Not a dramatic or a rapid dismantling, but it's going to happen nonetheless. People have been talking a lot about taper tantrums. That's a reference to 2013 when then Fed Chair Ben Bernanke was testifying before Congress and held out the prospect of beginning to wind back the Fed's QE program then, smaller than the one they've got now. That was enough to cause ructions across Asia and the world. The Fed backpedaled a bit and then began to ease off very gradually. The Fed is thinking about how it wants to do this. You're seeing around the periphery, including some parts of Asia, a tentative withdrawal of that already. Not a dramatic one, but a tentative one. China has already begun somewhat normalizing its policy stance. New Zealand has talked about interest rate increases. The Reserve Bank of Australia is likely to take a few steps next week. Bank of Korea may be the first central bank to actually lift its benchmark interest rate. That may happen as soon as August. That said, no one's in a hurry to do this quickly. You know, it's been observed in a number of places that the degree of stimulus that China unleashed, important as it was much less than what came from the US. That's true. And it's true that China is normalizing, but that's with a view to financial stability as much as anything else. If you go back to the global financial crisis, China unleashed a truly massive infrastructure programs. Many state-backed companies were left with a lot of debt. Authorities are keen to avoid that. You know, the second intangible, as I said, is something difficult to quantify, but it relates to, you know, with a globalization and with a, you know, the policy direction in some of the Asian economies that until now had been perceived as among the most open. So if you look at the globalization of capital and the globalization of talent and the labor market, you know, you can see that that really started to take off from the early 90s onward in the aftermath of the Cold War. And it's more or less continued unabated until the last couple of years. So for those who think that globalization slowed, that the deglobalization camp or the slowbalization camp, the real question is whether supply chains have been so upended by COVID and whether people want things so much closer to home that they're prepared to rip up the infrastructure and the procurement chains that have ruled for the past 30 years and which, among other things, have helped keep inflation very, very low. If you believe that something or everything has fundamentally changed as a result of COVID, then these supply chains have to change as well. If they are withdrawn closer to home markets, what does that do to the export-dependent economies in Asia? And I would include pretty much all of them in that, certainly Hong Kong, certainly Singapore, where I'm now sitting. You can add Korea, Japan, China to that, Taiwan, certainly. There are other issues related to that. We've talked about trade. Let's talk about global talent. Pretty much every day you'll read something in media in Asia about whether it's time for white-collar talent to go home. Be that to Japan, be that to Korea, be it to the United States, be it to Western Europe. We'll have to watch this one and see how it plays out. Certainly there is a sense that the politics of it have changed in many of these host countries. You know, in some ways they invented a model that places like the UAE have replicated, but do they want it anymore? Some of that reflects a very, very deep recession that the region's had. I just mentioned that Singapore's recession last year was the worst in its history as a republic. That is the worst since 1965. Some people are going to go home. Where there are perceptions that job opportunities for locals have dried up, you know, authorities are going to be attentive to that. So there's been a lot of press given, and I've written some of it, about anxiety felt among the global talent pool about what's happening in places in Asia. For folks who feel that Singapore is a good place to come from Hong Kong, people are citing changes to national security laws. People are citing the closing of borders. Mind you, Singapore's borders have closed. I don't know that anyone's borders in Asia are particularly open right now. So we'll have to see how that plays out. You know, the idea that you can go work somewhere on the other side of the world, base yourself there, do a regional job, run a regional office, run a representative office. And if something goes wrong at home, you can just hop on any one of a number of flights a day, be back in your home country in 14 hours or less, do what you need to do, pack up and come back and walk into the living room and be greeted by the kids pretty much anytime you want. You know, that's over pretty much everywhere. One very encouraging thing I saw from Hong Kong recently was the flagging of a dramatic reduction in quarantine. Coming from many places. Shortly after that announcement, Singapore reduced its stay-home notice from many countries to 2 weeks from 3 weeks. It would be great if it could follow Hong Kong's lead just a little bit more and cut it to 1 week. So I'll have to see how these things play out. I don't entirely buy the deglobalization issue. It may have changed the way it works. It's certainly possible to still hit a button on a computer and send a lot of money anywhere around the world very, very quickly. It's interesting to note that while Singapore Airlines passenger loads you know, are somewhat microscopic right now, cargo has held up. I think there's a temptation among white-collar folks working abroad to equate openness to the world with their own personal circumstances. But look, it's cargo ships leaving are full, cargo rates are going higher. There are disruptions to supply chains. It's not necessarily the worst of times for everyone everywhere. It certainly isn't the best. The pace of recovery will slow next year. The IMF says it. Most global forecasters say it. Private sector economists say it. So, you know, we'll have to see how this plays out. These may not be very satisfying answers, Donald, but I feel like we're in a very ambiguous time right now. You know, the recession is over. The public health crisis isn't over. We have degrees of reopening. We don't have full reopening. In some ways, many of these economies are operating in a kind of a netherworld. You know, they're not shut. They're not completely open. Right now, the strength of the global recovery is lifting many, many boats. When the pace of that recovery slows in the second half of this year and next year, that's when we're probably going to have to see the real policy innovation. Thank you.
Great. So Dan, maybe I'll take moderator's prerogative and ask a few questions that are probably more focused on you than Anna, and some of the other questions that are coming in maybe for both of you. So we'll put those off until after Anna's presentation. But I just had maybe a couple of questions and comments. I mean, I think one on the supply chain issue. I think at minimum, companies are seeking at least redundancy and resiliency, which means probably not total reliance on the previous supply chains, which could mean having both, let's say, Asian and closer supply chains in the West. So that may have an effect all by itself from a risk management perspective. But more politically, I'm wondering two questions really. One, do you see the Biden administration's policies affecting different Asian or Asian economies in general and their economic growth at all? Is there any sort of noticeable issue there in Biden policies? And second, there's been some discussion about the degree of coordination of central banks around the world, certainly between the US and Canada and in Europe and so on. Is there, you never hear about this, and it's probably because it doesn't happen, but is there any coordination between the Fed and the Chinese central bank on, anything except crisis management issues? Or is there a bit more coordination going on that may come into play as far as global as well as Asian economic growth and recovery?
Okay, so I'll just take the last question first. And I'll go back to the GFC as a starting point. One of the most notable points about global central bank cooperation, they would bristle at the term coordination.
Yeah, that's true.
Let's call it cooperation. In late 2008, and I remember this vividly, I was working in the Washington newsroom and the press releases started coming in. 7 or 8 global central banks cut interest rates almost instantaneously, predominantly from the G7, though Swiss National Bank, Riksbank in Sweden, some of the others joined in. Then about a minute or a few minutes later, there was a release from the People's Bank of China saying that it too was cutting its interest rate. So China's central bank, often seen as an outlier, it could be said more or less joined the global college of central banks at that moment. They were very careful to be seen acting independently of the G7 and acting in China's interests. Every central bank ultimately acts in its own country's interest. But the fact that it was so soon and in the same wave of interest rate cuts, you thought, wow, okay, we've got some serious global, we've got a global wave going on here. And China cut interest rates a number of times. When the central banks began withdrawing that stimulus in the early 2010s, China raised its interest rates as well. This time around, the same degree of coordination has not been there. China's revamped its monetary policy system somewhat, which may account for that. They're relying more on daily market operations to affect the flow of liquidity. But no, I mean, the dramatic Fed interest rate cuts of March, the return to QE, the rolling out of the swap lines, treasury lending facilities for central banks that did not get those swap lines. That's something that was not replicated, to my knowledge, by the People's Bank of China, certainly not in the same way. So, look, directionally, is monetary policy going broadly the same way? Yes. No one's in a hurry to dismantle a lot of what they put in place too quickly. but the PBOC has been largely absent from many of the waves that we've seen, certainly of G7 and Western aligned monetary policy. You know, Donald, if I could just take the opportunity to come back to something that I said I'd allude to, but I didn't get a chance to talk about it in my introduction, in my general remarks. If you go back to the first real financial crisis that this region, East Asia, suffered in the post-Cold War era, that was the 97-98 Asian financial crisis. Now, at that point, it was pretty popular to talk about everyone, including Malaysia, where I was stationed at the time, as being a tiger or the next tiger in waiting. It was a term that was ubiquitous. Many attendees may remember that. Feels like you've got to go to a museum to see that term. But what's striking is some of these Southeast Asian economies never quite regained the vigor that they had before then. Since then, there's been the global financial crisis, and now this one. You know, it may have peaked for many of these Southeast Asian economies, far from being the next wave to follow South Korea, Taiwan, Hong Kong, China. They may risk slipping into a permanently slower growth lane, which, you know, is a tragedy, but we need to be alive to that. It gets to what I was saying earlier. Arguably, there is no single Asia anymore. There are regions and there are pockets.
Excellent. All right. Well, a lot of excellent, interesting comments in there, and a lot to unpack and a lot to see where things develop.